Most Americans think they understand taxes until they see their paycheck. Millions of people work harder, earn more, and yet feel poorer at the end of the month. Even when salaries go up, the bank balance doesn't reflect it. Where does all that money go? The truth is, the U.S. tax system is complex, layered, and psychological. It's not just about paying the government, it's about how money quietly leaves your hands in ways you might barely notice. In the United States, taxes are the government's main source of income. This money funds roads, schools, hospitals, national defense, and social programs. But unlike other countries, the U.S. doesn't rely on just one type of tax. Instead, it has multiple layers, federal, state, and local, each taking a portion. This layered structure is why taxes feel invisible but heavy at the same time. In the largest portion most Americans pay is federal income tax, collected by the IRS. The U.S. uses a progressive tax system, meaning higher earners pay a higher percentage. However, many people misunderstand this. Moving into a higher tax bracket doesn't mean all your income is taxed at that rate, only the extra portion is. Because this is poorly explained, many fear raises or overtime thinking it will hurt them financially, when in reality it usually doesn't. Income tax is only the beginning. Before the paycheck even reaches your account, payroll taxes are deducted. These fund Social Security and Medicare, programs designed to support retirees, disabled individuals, and health care for seniors. Payroll taxes are flat up to a certain income level, which means lower and middle-income workers feel the burden more than high earners. That's why paychecks often feel smaller than expected even before federal and state taxes are applied. State taxes add another layer. Some states, like Texas and Florida, don't charge state income tax at all. Others, like California and New York, take significant percentages. Two people earning the same salary can live completely different financial lives depending on their state. And it doesn't stop there. Cities and counties add sales tax, property tax, and local fees, which quietly take more money from everyday spending. Sales tax is deceptive because it feels small, a few percent per purchase, but over a year it can total thousands of dollars. Property tax works similarly. Even after you own your home, you pay the government annually. In effect, you never really stop paying taxes. The system becomes even more unequal when deductions and loopholes are considered. The U.S. tax code runs thousands of pages filled with legal ways to reduce taxes, but most people don't know how to use them. Business owners, investors, and wealthy individuals often pay less than regular employees, not by breaking the law, but because the system rewards certain types of income. Capital gains, business expenses, and asset depreciation are taxed differently than salaries, which is why two people with identical incomes can end up paying very different amounts. Inflation adds another invisible burden. When prices rise but tax brackets don't adjust fast enough, people pay more tax without becoming richer, a phenomenon called bracket creep. Over time, this quietly drains purchasing power. Why is the U.S. tax system designed this way? Partly history, partly politics, and partly human behavior. Complex systems are easier to maintain because fewer people question them. Spreading taxes across many small deductions instead of one big bill reduces pushback. Taxes are not just an economic system, they are a psychological one. Ultimately, understanding the U.S. tax system isn't just about paying your share. It's about seeing how money flows, who benefits from complexity, and why financial literacy is more important than ever. Once you understand how taxes truly work, you stop blaming yourself and start seeing the system clearly. That clarity is the first step towards smarter financial decisions.